In this video, we're going to talk about 5 ways to improve your financial situation that can help you boost your stimulus check, increase your Paycheck Protection Program loan, and boost your tax refund for 2019. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner, helping you reach your financial goals. Now, some of the strategies that we're going to talk about have small changes, but can have big impacts on your entire financial life, especially in hard times like we're facing right now. Now, the first strategy I want to talk about has to do with your Roth IRA. And I've talked about this strategy in a previous video, Roth IRA Tax Hacks during a recession. But it's so important to make these changes, and especially when your situation changes, to go back and look at the facts to see if there's other situations or other decisions that you should make. And this is actually one of them. So if you've been making a contribution into your Roth IRA for 2019, you can actually still take that money out of the Roth IRA without any taxes or penalties. You could take that money and put it into a traditional IRA instead. So this is really two strategies in one. So first, we're taking the money out of the Roth IRA to put it into the traditional IRA. And the reason you would want to consider doing that is because in 2019, there's a good chance that your income was higher than in 2020. So a traditional IRA goes in pre-tax and it's going to reduce your overall taxable income. That could possibly boost your total refund or just reduce your overall tax liability for 2019. And you probably chose the Roth IRA because it's a great retirement account. You put the money in after tax, but then it grows tax deferred and then comes out tax-free in retirement. And you can use it for a first-time home purchase. You have access to the principal at any point. You could use it for education planning. There's a lot to love about the Roth IRA. But in times that you need to reduce your total income, the traditional IRA is a lot more effective. So you can use the traditional IRA to reduce your adjusted gross income, which will put more money in your pocket immediately from a tax refund or a reduced tax liability. And you could still do it for 2019. And if you're over the income thresholds or even in the phase out for the stimulus check, you can also boost your stimulus check. And before you do this strategy, going from the Roth IRA to the traditional IRA, you're going to want to check your filing status and your income limits, because the traditional IRA works a little differently than the Roth IRA. But I have 2 videos to show you the 2019 contribution limits and income limits and the 2020 version as well. Now, if you want to know more about this strategy, check out that video, Roth IRA Tax Hack during a recession. Number 2 is the Roth conversion. Now, the strategy we just talked about is not a Roth conversion and it's not a recharacterization. That was completely separate. That was a different strategy altogether. That was just taking out the contributions and putting it into the traditional IRA. This one's going in reverse. This is going from the traditional IRA over to the Roth IRA. Now, if there's a time to consider a Roth conversion, it's probably now, because you've maximized the pre-tax contributions, so you've helped reduce your total tax liability. But unfortunately, there was a downturn in the market. But that means that you convert those dollars over into a Roth IRA. When the market comes up again, then you won't have taxes on that growth because it's a Roth IRA and it comes out tax-free. And you might be thinking that this is a terrible time to sell out of one account to go into the other, but you don't need to. You can take those same stock positions, ETFs, or mutual funds and move them into the Roth IRA. You don't actually need to sell and then rebuy later on. And you have to figure, with this $2 trillion plan, which just got boosted by another $250 billion, you have to figure tax rates in the future are going to go up. But there are a couple of things that you need to be aware of. Doing a Roth conversion is taxable. So if you do it in 2020, it's going to be taxable on 2020's tax return. So you want to make sure that you're checking your income limits and your tax brackets, because you don't want to accidentally put yourself in a higher tax bracket or disqualify yourself from some credits or deductions like the stimulus check for $1,200 or a traditional IRA. And the taxes owed on the Roth conversion don't have to come from the money that you're converting. It can come from another source. That way you can maximize the amount of money that's in the Roth IRA by keeping it all in there. And if you don't know, there's a 5-year rule on Roth conversions. What that means is the amount that you convert into the Roth IRA, you can't take out of the Roth IRA for at least 5 years. Normally, when you make a contribution into a Roth IRA, you could take those dollars right out. But because it's a conversion, you have to leave it in there for 5 years. So if you can do a Roth conversion, it's worth taking a look at. Number 3 is going to piggyback off of number 2 on the Roth conversion. So there's a waiver of the RMDs for 2020. And that is in section 2203, the temporary waiver of required minimum distribution rules for certain retirement plans and accounts. So you don't have to take the RMD, but it doesn't mean you shouldn't do anything because your RMD is based on your age and the count balance on 12/31 of the previous taxable year. So that means that your RMD for this year, for 2020, is based on 12/31 of 2019 and your age. Now, if you don't take that RMD and you leave it in there, then next year, your account balance will be larger than if you did take the RMD. That also means that your RMD will be larger. Now, if you do a Roth conversion that we just talked about, then you can still pay those taxes, but you can convert those dollars into the Roth IRA. In a normal RMD, you can't put those dollars into a Roth IRA. And just as we talked about with the other strategies, you want to check your income limits, your tax brackets, and making sure that you're not disqualifying yourself from any credits or deductions. Now, number 4 has to do with the profit sharing contribution. So we're going to go to the other side of the spectrum, back to the pre-tax accounts. Now, I'm singling out the profit sharing contributions because it is a type of contribution that you can make pre-tax that you can still do for 2019. So if you are a small business owner and you make a profit sharing contribution for 2019, it's going to reduce your total taxable income, possibly boost your tax refund, and put more money back in your pocket while still boosting your retirement accounts. And with the changes in the CARES Act, where you can borrow up to $100,000 out of certain retirement plans, you might still be able to access those dollars immediately while still reducing your tax liability. And when it comes to the Paycheck Protection Program, the rules say that it's all retirement planning contributions for 2019. What it doesn't say, there is not guidance on when those contributions were made. Now, I will say this about the Paycheck Protection Program. Without this guidance, it would be really confusing if it didn't include the profit sharing contributions that you make right now for 2019. Because what if you made those same contributions on an annual basis and you did that last year? So if you did that last year for the previous taxable year, then it would have to be one or the other. So if you've been making profit sharing contributions after 12/31 of the taxable year, because you can, then this contribution might count for the Paycheck Protection Program. Now, this is something that we're going to have to wait until see for further guidance, or if your bank includes it or discludes it. Now, each bank is processing these things differently, so it's unclear at this point, but this could be something to help you boost your Paycheck Protection Program loan. Now, if you tie this all together, you could possibly reduce your taxable income, increase your Paycheck Protection loan, and still have access to borrow that money right back. And the things you're going to want to check for are your plan. Are there fees to do the borrowing? Will the Paycheck Protection Program work for you? And how much money do you have on hand, and how fast can you get back your tax refund if you put the money into the profit sharing plan to reduce your taxable income? All these are factors that you're going to want to take a look at before you do this profit sharing strategy. Now, number 5 is similar to the profit sharing contributions, but it's with a SEP IRA. So if you're a small business owner, self-employed, independent contractor, sole proprietor, you can still open up a SEP IRA. Or if you have one, you could still make that contribution for 2019. And this could have a lot of the same effects as the profit sharing contribution, where you're putting this money in pre-tax, so it's reducing your total taxable income, which will boost your refund or reduce your tax liability, possibly qualify you for a stimulus check or more of a stimulus check, and maybe even a bigger Paycheck Protection Program loan. There's just a lot of small things that you can do to your financial life that add up over time, that'll help boost your retirement and reduce your taxes or control your taxes and put you in a better financial situation. So you want to look at a lot of these small things so you can improve your financial life and get through this difficult time. If you have questions, put them in the comments. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.